James, thank you very much for joining us. We're here today, it's the 1st of August, it's therefore very early into the new month, and hence I believe you only in fact have returns data for the funds up until the 28th of July. So you're going to be talking about performance July to the 28th. Hence in that context, James, how did the Harmony portfolios fare?
Yeah, pretty well actually, up to the 28th.
Yeah.
The caveat there is that the last couple of days of the month look actually like they're going to be reasonably weak. So I'd expect the total month returns to come in underneath what we've achieved the 28th. But taken as a whole, the 8 portfolios, only one in negative territory up to the 28th. The others in positive territory. The main drivers of return in very much a regional issue as we've seen in the last couple of months. So recent laggards, the Australian funds, the Asian funds actually doing better this month as those markets had a stronger period, whereas the others perhaps a little bit weaker, which have done better recently. So it just shows the sort of variety of returns drivers in that range. Over 3 months, all in positive territory, so a similar story, a slightly better story actually over 3 months, with all the funds generating what are relatively handsome returns between 2 and 4% in their reporting currencies over what is a reasonably short time period. So we shouldn't get too excited about that, of course. All those returns are net of fees, and I think again it's probably worth reiterating that it is only to the 28th, so it's not the entire month.
Okay, and then looking at kind of the main themes last month, what did you see in markets?
Well, it was not dissimilar to the previous month. It was very much a month which was dominated by geopolitics and other sort of exogenous shocks, if you like, rather than the theme we've seen in maybe the previous 6 months, maybe 12 months, which was very heavily dominated by central bank activity. That certainly wasn't the case this month. Surprisingly, perhaps, given we were focusing a lot on ISIS and Iraq and Syria last month, that's pretty much dropped from the headlines completely. The activity in Gaza between Hamas and Israel is much more pertinent today, and there's obviously some severe activity going on there. But also the Russian-Ukraine conflict took a turn for a disastrous turn, really, as the Malaysian airline was shot down over Ukraine. And even through that period, the market was reasonably resilient to these kind of significant exogenous shocks. But towards the latter end of the month, as it became apparent that incident has sort of steeled the international resolve to start to impose stronger sanctions on Russia, that's actually been what's weighing on the market now. And I think that's largely because the scale of the sanctions which are looking likely to come into place and that have started to come into place already are such that they will actually impact global businesses that have activity in Russia to an extent as well. Now, clearly that's not their intention, but I think that's likely to be the consequence of some of these sanctions. Pleasingly though, from a portfolio management point of view, there appears to be no appetite whatsoever for any sort of greater intervention, any kind of militaristic moves, which clearly would be a different kettle of fish really from a global risk point of view. I think that would really spook the markets. But nevertheless, a market that's been resilient to mini shock after mini shock is finally starting to show a little bit of a sort of realization of the gravity of a number of different things going on out in the marketplace. 2 other tests we shouldn't forget about that happened this month. Banco Espírito Santo in Portugal, essentially hitting the buffers. The actual quantum of that is not massive, and that's reflected in the fact the market didn't react to it very poorly, but it is a salutary reminder there is still a lot of risk, not only in Europe but in the financial sector globally. Things are still, there's a veneer of quality everywhere, but there are still some pretty substantial problems underneath the surface. And then Argentina's default on its outstanding debt obligation. We knew that was a pretty high likelihood of happening, so again that didn't really surprise anybody, didn't really move the markets, but again it's a reminder that investing in emerging markets is not without risk.
Taking those things together very quickly, Eastern Europe you've mentioned, the Middle East, Argentina, Portugal. Can you contextualise some of that? So what do we kind of see returns-wise from markets?
Well, actually, emerging markets outperformed developed markets over the month. They were in positive territory, whereas DM was down. And in fact, year to date now, emerging markets are ahead of developed markets, which has been only just quite a recent phenomenon. The first few months of the year was very much the opposite, really. If we stick with developed markets for a minute, Asia ex-Japan was the strongest returning market,
Okay.
followed by Japan, and then Europe in negative territory, and US and UK up to the 28th were borderline flat, but the moves post the 28th have just dragged them into negative territory. Whereas obviously Eastern Europe equities were down, have been weighed on quite heavily by the conflict in Ukraine, but other regions in the emerging market complex have done sufficiently well to actually drag that market into positive territory. Looking at the bond markets, global government bonds continue to drift up. European government bonds are hitting literally all-time low yields, which is remarkable, really. And elsewhere, yields are sort of relatively stable. You're just getting a little bit of coupon income on the government side of things, but no big moves there. High yield markets, we started to see a sell-off in high yield, which is interesting. Clearly, that's something we've been flagging for a number of months in our portfolios that can hold high yield. We sold it aggressively from our portfolios in the first quarter of this year. You'll have noticed that Janet Yellen came out in the press or in her statements and said that high yield was looking expensive repeatedly, and that seems to finally be coming to bear on the markets. We think it's expensive still, but it's rational to see a setback in this asset class. And there will be a time, if it falls back significantly from its present levels, that we'll look to add again. Elsewhere in the markets, property securities outperformed the broader equity market, and it was not a good month, as I said, for high yield or convertible debt. But cash, was as a store of value, a bit of a drag on returns in a month where government bonds drifted up. But compared to global equities, it was actually a store of value.
Okay. James, you've touched on two themes there that I would imagine for you as the portfolio manager would be pleasing. Your overweight to emerging markets is starting to really come through this year, and secondly, having maybe slightly early, but high yield really has come off with comments, as you say, from Janet Yellen of the Fed. Let's look at portfolios today. What other ideas have you got in there?
Well, the Harmony portfolios have had a couple of important but small changes take place in July. A couple of manager changes. We've added a new manager called Kopernik, who are global all-cap contrarian strategy. Quite a high-risk strategy. It's a volatile one, but it's one that we think complements our existing holdings very much. But we've added a small 1% initial position in that manager, which we'll look to add on a sort of opportunistic basis. That's brought our equity weighting up a little bit, but on the whole, our positioning is still very much neutral, developed markets, overweight emerging market equity. We also added a bit to our property securities holding. We think that property securities are still reasonably cheap compared to the broader market, and we think they've got a profile that will suit prevailing market conditions today. So we've added to our existing manager there slightly, and remember, that's also augmented by our global infrastructure position. So if you include property and infrastructure, we're fully weighted now in that sort of part of the portfolio. Within the fixed income part of the portfolio, the main change there was to add another manager, Muzinch's short duration emerging market credit fund. It's a relatively low duration fund, relatively low volatility as a result, but it's one that profits from the yield pickup available from the corporate sector within the emerging market universe, but without taking too much interest rate risk. So we think it's a nice addition to the sort of suite of fixed income strategies we've got in that portfolio. As a consequence of all these changes, cash has come back a little bit, but it has been a drag on performance recently, and so that's the main sort of portfolio positioning today.
Okay. And finally, James, as ever, everyone's interested to hear, what do you see going forward? Talk about, what's coming in the next 6 months and so on.
Well, we've had an interesting few months where the markets have drifted up, despite all that's been thrown at it. But I think the remainder of the summer might be a bit more challenging. This is very short-termist. Obviously, we don't really trade around this. But my view is perhaps we'll have a summer where markets are a little bit more flighty than they've been recently. Volatility has started to spike up, and I think that's actually quite healthy, because we've had a situation where markets have gone up almost regardless of what the prevailing winds have been, and I think it's useful for them to show a greater degree of sensitivity to what's sort of going on in the here and now, even if we're buying them for tomorrow's prospects. Maybe sell in May and go away would have been a good thing to do. Let's see what happens at the end of the summer. But as of today, I think there are short-term risks that will impact portfolios. But longer term, there are still opportunities for us as disciplined long-term investors. Valuations aren't too bad in the equity markets still. They have drifted up, as I've already said, and earnings haven't kept up with the margin expansion, but they haven't. Most of the global equity market hasn't got expensive yet. It's a fair value, and there are still opportunities there for high quality managers to add value. So we're still pretty confident about the global equity market. Looking at the fixed income market, as you know, we think government bonds are expensive. We continue to believe that, and we don't think there's value there. But we will take selective positions in the credit markets as and when opportunities present themselves, and also emerging market debt, for example, is a nice opportunity for us in these portfolios. I think turning to economics, globally things seem to be okay, actually. GDP growth is pretty reasonable. US is looking okay. The rest of the developed world is looking all right. There's a bit of a question mark over Europe, but even Europe is sort of struggling through. Even China's numbers are looking reasonable. But none of them are getting to such a level that inflation is becoming a big problem, so you don't have to have that sort of knee-jerk policy response. So at the moment you've got this sort of becalmed policy environment where you can continue to slowly unwind this extraordinary monetary policy without having to do anything, or the central bankers aren't having to chase their tails. They can be quite methodical, quite iterative, and that is probably the most positive feature about what's in the markets today. Is central bankers can be very gentle at removing their foot from the pedal, which they've done expertly, I think, in getting us out of the crisis. I hope that going forwards they can do the same in terms of removing this extraordinary stimulus. So looking forwards, there's still reasons to be cheerful from an asset valuation point of view, and a reasonable economic backdrop, and one that's favourable from a policy response point of view. So again, it's not 18 months ago. Markets aren't particularly cheap, but there are still opportunities to have value-adding positions in portfolios today.
James, thank you very much for joining us. Thank you for your insights. I'll reiterate just one more time that the data available to you, the official data on the funds available to you at the time we recorded this, was to the 28th and not therefore the complete month of July. Again, thank you very much.
Thanks, Richard.